What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies. And if you stick with me towards the end of today's video, I've got 5 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we certainly have a solid-bodied red bar with just a little bit of an upper wick and just a little bit of a lower wick, certainly nothing significant. The reason I bring those data points up is because we did technically gap out of the weekly range to the upside here. It did not produce any significant buying pressure, and we also moved into a very important daily and weekly level of support, and that also did not produce any significant buying pressure. So to see a relatively weak close down at the bottom of the weekly range, and also know that part of this weekly candle is comprised of the CPI gap down, I would say that the sellers are clearly in control here from a structural perspective. From the location standpoint, we do have on the bar-to-bar count a higher high as well as a lower low. That classifies this as a bearish engulfer, which is the exact opposite of what we said last week, right? We were dealing with a bullish engulfer that closed strong at the highs. We were thinking bullish, and you might be thinking, all right, you're just flip-flopping back and forth. Well, number one, I would say please do change with a changing market environment. And number two, I think it's really a demonstration that volatility is being grossly mispriced at this point in time out there in the marketplace ahead of the Fed decision. In terms of the takeaways of the structure and location both being bearish, obviously we've got our first weekly close underneath the SPY 390.85 and what was prior support, then turning to resistance, breakout, support, right? So we're closing underneath that, and we do have now confirmed a lower high from here to here. So with the close underneath, with the lower high, I would say that the outcomes into this upcoming week should be leaning more on the bear side as opposed to the bull side. It's not to say that we can't get a dead cat bounce. We'll discuss that on the daily time frame in just a moment, but weekly chart does look bearish here. Let's quickly take a peek at our volume profile on the weekly, and I do want to keep tabs on our high volume node. Remember that this was essentially the SPY 390.85, and we've closed underneath it. Remembering that markets like to move from high volume node to high volume node, what is the next high volume node? Well, this completely tapers off to the downside, and then we've got nothing at least on par with volume at these types of levels. So let's go ahead and grab some more time here. I'm not showing you this 5-year to scare you. I'm not saying that the SPY moves to the next high volume node here, which is roughly 340, but we've got a big low volume node underneath us. All I'm saying is that if we do rotate down towards the bottom and the lows of June, then things can get nasty if we breach those areas, just based on the lack of volume support here on the weekly time frame. Again, this is not an argument that this happens this upcoming week. I'm not trying to scare you. I'm not saying we go to the Great Reset, which is the highs pre-COVID. I'm just saying that there's a lack of volume support underneath us here that I do want you to be aware of. Let's drill on down to the daily time frame now and start talking about tradable levels into the upcoming week. What do we have in terms of numbers, sentiment, psychology, all of that good stuff? So zooming in here, bear with me, thank you very much. From an expected move perspective, as we talked about just a moment ago, the market is doing a horrible job of pricing in risk. Why can I say that with confidence? Well, here is the prior week's expected move. Here's the close on Friday. A 2 sigma plus move to the downside. Absolutely horrific job from the options market. This upcoming week, I will say that the expected move is slightly expanded. However, the main takeaway that we use it for, right, is if we move to the top of the weekly expected move, will the trend change? And the answer is absolutely not. It will produce a lower high from here to here to here. That is a lower high that preserves the daily downtrend. And if we move to the bottom of the weekly expected move, obviously that's a clear lower low. That should go without saying. That is continuation of the downtrend. So expected move is bearish. No doubt about that. Lower high, even if we move to the top end here. Now, in terms of levels, let's talk about what unfolded from a psychology standpoint on the CPI gap down. Let me just make this a little easier on your eyes and we can talk about it together. There we go. So here's our CPI gap down on Tuesday. Did any of that gap fill? Very, very little. So buyers not stepping up and quote unquote doing their job of repairing the structure. That's an indication that number one, sellers are strong. We produced a spike, which I'll show you on the market profile in just a moment on the CPI gap down day. What happened on Wednesday and Thursday? All of the price acceptance was underneath the spike. That is our 397.75 level. That's another check mark for the sellers. What else happened? Obviously, we get a bit of an exhaustion gap down on Friday. I'll talk about why exhaustion in just a moment. But the next main bearish takeaway is what we also saw in the weekly time frame. Close underneath 390.85. Now, what did I mean by exhaustion gap? So the market has been horrifically down. This is the worst week in the market in quite a long time. It was a historic week last week. But by exhaustion gap down, I mean, we can see we open here. The lower wick would imply that we drove lower and we closed above. So the sellers ran out of bullets at the lows. Sellers are feeling exhausted. I would say that early on into the upcoming week, we should be watching out to see if we can get a move above Friday's high to close the overhead gap that's over 386, closes up towards 388.75, and then make the move for the back test into 390.85. When and if we get here, that's where I would quickly and promptly shift my tone and say, okay, this kind of dead cat bounce can end here. This is just a back test of this level, right? So if you start to see any inverted hammers here, if you see intraday double tops, if you just see overall failures around 390.85 to move higher, then that is a great location for a back test short. You get a break, retest, and then rollover. Stop goes right over the top there above 390.85, and you're probably, at least for swing trades, right, retargeting the low of Friday, if not the gap fill from back in here. Those numbers, by the way, just to give them to you, are 380.55, closes down to 378.64. So that is what I would watch out for early on in the upcoming week. Everything is bearish. However, we have an exhaustion gap down. We can back test this level and then look for some rollover off of that. If the market accepts above 390.85, I would call this neutral in here, and I'm sure you can tell where I will flip my tone back to the bull side is recapturing the base of the spike. That is the 397.75 level. As long as we're underneath that, I would say, and quite clearly, right, based on the weekly expected move and what we just discussed, we will likely produce a lower high. If the market does not rally at all early on in the week, again, I don't know that I would chase it short down here. I really want to see the move higher and then the rollover. Chasing it short here is being, last one to the party, basically. You have the worst trade location. Where do you place your stop? I suppose maybe over Friday's high, but that's just adding fuel to the fire if we start to get something like this, right? So I wouldn't really participate short here after all the destruction that's already taken place. You're short in the hole. You have the worst trade location. I think that will come back to bite you. So overall, that's what I'm watching out for to the upside. And of course, as we mentioned earlier, FOMC announcement is on Wednesday at 2 o'clock. Maybe we did or did not mention that earlier, but 2 o'clock Wednesday, Jerome Powell is going to come out and give us either the 75 or 100 basis point rate hike. So we're talking about things happening prior to that, right? It's a total crapshoot at 2 o'clock on Wednesday. We'll update you after the market closed that day, and more information on that coming as we get to the TNX in just a moment. Anyways, here's a Fibonacci analysis of the S&P 500, what's going on from this perspective. So from the lows up to the highs, what you'll notice is we finally closed a daily bar underneath that dreaded 61.8. What does that mean? Well, it means the more bars we continue to close underneath, the more time we spend underneath, the higher the likelihood that we do see the 100% retracement into the June lows. And that sort of aligns perfectly with what we were just discussing on the SPY weekly timeframe as well. If we can recapture the 61.8, again, I don't think we're out of the woods. That's where I would reference the spike as being our critical level, 397.75. So as of right now, breach and close underneath the 61.8 does strike me as bearish, 100% retracement more likely as opposed to less likely at this point in time. Then the last Fibonacci perspective I'll give you is from the high down to the low of this most recent downdraft. If Friday's low will hold as quote unquote the true low, notice that your 38.2 is still very far overhead. It's even past the spike that we were just discussing, our 397.75. So if we do get a massive dead cat bounce and rally here, we're not out of the woods. We are still very likely going to be underneath 38.2 from this perspective, which is also bearish, okay? That's what I've got for you in the SPY itself. Let's take a look through the sectors now and see what's going on. Remember that the SPY can only really do what these 11 sectors do in terms of their weight as well, right? So here's the XLP. Remember that this is D for defensive, so to see it coming off, I'm not as concerned with it. Obviously, it's bearish pressure for the S&P 500, but as and if we were to move underneath the 69 handle, give or take 68.20s, this low from June, that's where it's like, okay, major red flag for the market. Please keep an eye on the XLP. If we rally early on this week, the only thing that gets this back to neutral is a higher low above 72. If we get a higher low above 72, fine, it'll neutralize things, not the end of the world. What we don't want to see if it does rally, if we do get the upside, is we do not want to see it leading the charge. We really don't want to see it over 75 roughly. Remember that again, this is D for defensive, so it should not lead the charge if we're scouting market bottoms. Moving along. What's happening in the real estate sector? Bearish, we kind of talked about in last week's video, or at least last Wednesday's video. We talked about the move into the back test of the neckline and expecting some rollover. That did pan out. Unfortunately, this is such a lightweight sector for the S&P 500. It's very difficult to make a lucrative trade here in the real estate market. Regardless, I would say that this chart clearly looks bearish. You're looking for now lower highs to be produced underneath 41.75, and then rotations back down for the equal low. There's nothing really that will save the S&Ps here in the real estate sector. Next up, XLV, healthcare sector, as we know, second heaviest weight by market cap. So let's spend some time here. Here's the monthly range, and what you'll notice is a surprising amount of relative strength into the end of the week from the healthcare sector. Now, as we know, it is technically D for defensive. People will need healthcare regardless of the economic situation. However, being that it's the second heaviest weighted market, second heaviest weighted sector in the S&P 500 by market cap, it needs to participate in the upside for any rallies or holds of support to take place. So the fact that we've held here for a possible higher low instead of the S&P, which has made a lower low, right, does strike me as being important. If the XLV can hold up over 127, the true level is 126.75. If we can hold up over that, it would be neutral here, and that would be more reassurance that we might get a dead cat bounce early on in the upcoming week. If early on we breach this and move to the downside, I would not be as confident in the dead cat bounce over the Friday high in the S&P 500 to fill the gap. So use 127 as your critical level. If we do make the move into 125 here, look out below, kiss this thing goodbye. We're coming in off of lower highs, lower highs, lower highs, equal low, short proximity of time, monthly low end of the range. Goodbye, right? Not a good look for your S&P 500. So far, so good with the relative strength, but I'm just giving you that as a scenario if 125 breaks. Utilities up next. XLU starting to come in a little bit, starting to look a little bit more, oops, I don't know why that zoom keeps happening there, but starting to look a little bit like that double top, right? We are at the neckline. Overall, I could see this ranging out. I honestly could see this going sideways here and not giving us what we want. What we want ultimately is the move underneath 74.16 to get closer to the 71, this kind of gap, right? If utilities can make a move back to here, the market does seem to be more comfortable. Remember that this is D for defensive. We do not want it leading the charge. So steps in the right direction, but as we'll see in the ratio grid in just a moment, we're not out of the woods yet from utilities kind of being relatively strong, right? Don't forget that these are basically still right up at all-time highs. Not a great look. Next up is the XLK, the tech sector, perhaps the most important sector of them all, heaviest by market cap, of course. This is really bearish, which is why it's so important that the XLV remains above its 125. Notice on a relative basis, this has already moved underneath the equal lows. Yes, we have the exhaustion gap from Friday. Yes, we could see a dead cat bounce for the back test of 132, but that does not get us out of the woods. Of course, that will produce a lower high. So just like in the SPY itself, look out for a back test short here. Stop goes right above, retarget the lows in there, and that is your downside trade in the XLK. That's the bear case scenario. Again, early on in the week, I could reasonably see some lift, but we are not out of the woods. This chart does strike me as being more bearish than bullish. Next up, we've got the XLY, what's going on in the consumer discretionary space. Again, a little bit of relative strength, honestly, a little bit closer to what we just saw in the XLV, noting that we're still above this really weak level, and I want you to carry that forward as weak. Sure, we could see a bounce, but if we roll over and move back to this level, I'm treating that with extreme caution. So we do technically start to get a little bit of super support if the trend line and horizontal level are going to be there at the same time. That would be later on in the week. But if we start to come into these equal lows, remember that there are quite clearly going to be some stop losses stacked up in there. If we breach that and go for the stop run, big bearish drag for the S&P 500. I would start to honestly target a back test of the breakout point. So just kind of playing catch up, if you will, so to speak, with the S&P 500. There's the ascending triangle breakout point. Obviously, the SPYs are underneath that already with the close under 390.85. I would say, again, if this breaks, that is your downside target. Obviously, bearish drag for your S&P 500. In this general zone up here, Obviously, we're off the highs, the local highs here, which is more bearish. But in this area, I might just be more neutral and not read into the XLY too much. A higher low above 161, that might be a little bit more promising for upside, but until it proves it to us, kind of just neutral in the XLY would be my feeling there. Next up is the XLF, financial sector. What's going on over here? Faring okay, knowing that rates do help out the banking sector ultimately. So overall, hammer candle, exhaustion bounce, yes, still above the equal highs, just like what we saw in the XLY. Carry forward 3250 as an extremely weak level. If retested off of the lower highs, look out below. That does not strike me as being a good thing. If you test this in short proximity of time, the breakdown there can lead to 3150, big bearish drag for the S&P 500. So what am I going to do in the XLF? Basically, just like the XLY, neutral in here. I think it's just volatile. I think it's just choppy. Lower highs that continuously are produced underneath 3375. Fine, maybe the bears have an edge if we rally, backtest, and break back down. But ultimately, the better short in financials is underneath 3250. And obviously, that's bearish drag for your S&P 500. If it flips to the bull side, as we always say, it's got to be a higher low, and it's got to prove it to us over 3375. Next up is communications. Comm sector has been incredibly weak. Nothing to really say here that we haven't already reiterated over the past week. Again, exhaustion gap down, maybe. If it does rally, it's still way underneath the June lows, or at least coming in for the backtest of the June lows, not just the breakdown, the breakout level, backtest up here. So that does strike me as extreme relative weakness, really bearish here in the XLC. I would not be looking for longs in communications for the dead cat bounce. If you want to trade it early on this week, my go-to would be anywhere where there's relative strength. I would probably just trade the SPY itself instead of going into the sectors looking for that move. So yes, backtest can happen, 53.69, any lower highs underneath, bearish, looking for continuation lower. To give you a downside level, 49 is coming from way off to the left. That was after the rally from the rebound of the sickness, if you will. XLB, materials, lightweight sector. We're not spending any more time here than we have to. Exhaustion gap down. Even if we rally, this will not save the S&P 500. So we're not paying any more attention to it than that. If it rallies, great. If not, no big deal. Next up, XLI, industrial, 7%, as we infamously say, of the S&P 500. Bigger exhaustion gap down than almost everything else we've seen on the Friday session, right? Really, really considerable move lower here in the industrials, and obviously it's closed underneath its breakout point from here. So really bearish give back, honestly, on the gap down. If we move above, the gap fill is the trade, and that's all I would do. I would not overstay your welcome on the XLI. Could it continue? Yes, but given the relative weakness from the gap down on Friday, I don't know that I would push my luck past the gap fill. So if we get the exhaustion bounce, if the market's rallying higher, XLI might be a place to trade for that gap because it's so pronounced, but I would not overstay your welcome. If we can't get out of our own way, if we partial gap fill and roll over, not a great sign. Again, at the end of the day, it's only 7% of the S&P 500, so keep an eye on it, but it's not quite as important as the tech sector, healthcare, or financial sector. Last but not least, before we get to the ratio grid, energy sector, what's happening here? Finally starting to look slightly better. So utilities and energy are starting to look like they may want to cooperate ever so slightly. We do technically need the daily close underneath 78.41. Otherwise, we are not out of the woods. Remember that this has been a break, retest, and hold level from in here, but we have produced a lower high from there to there, and we have at least exploration, butchered that one, an exploration underneath that 78.41 from Friday. If we can continue to get some downward draft underneath that level, it does strike me as the defensive sector here, energy, giving back a little bit, which is a good thing for trying to find a bottom in your S&P 500. Next up, we've got the ratio grid. Let me load up the proper grid here. If you don't know what this is, top right-hand corner shows you how to set it up. I've got a little tutorial for you. In the top four, we have our risk-on sectors, and what you'll notice is that things look great from a risk-on perspective, barring the tech sector, and as we saw on the structural chart just a moment ago. XLV, fantastic, great relative strength. We talked about that on the structural chart as well. XLY, we talked about that. XLF, we talked about that, right? So these three things are pointing higher, but because the XLK is the heaviest weighted component of the S&P 500 and we're on the brink of a rate hike, I'm not necessarily sure that I would completely flip the script and just start scouting for bottoms. If the tech sector does want to start cooperating, if the tech sector does start to see a better bounce, then yes, the market conditions right now are sort of favoring more of a risk-on look. If we look at the risk-off sectors, the bottom four, What do you notice? The XLP is rolling over. That's a good sign. Real estate sector rolling over. That's a decent sign. Energy, it's starting to go sideways. I mean, ultimately it is higher, which is not great, but at least it's not continuing this trend to the upside. So it's getting there. I'm not willing to call it purely risk off, turning off yet, but kind of neutral. And utility is still a thorn in our side, right? So starting to get there, but with this XLK not cooperating and with the utility sector still strong, we're not there. We're not there. It would really require, a less than expected rate hike, possibly. The XLK would obviously, I would imagine, shoot higher big time if we got like a 50 basis point in the face of the market's expectation of 75. I doubt that, but let's talk about it now. Let's go on over to the TNX and see what's going on out here. So just to sum up the ratio grid, right? Risk on does look decent, but the market context of the rate hike around the corner does not bode well. As we've been saying in the TNX, very simple to sum this up. Number one is that the market likes lower rates, and number two is that the market likes stable rates sideways. One of those two things. Is this stable or is this sideways? It is not stable, and if we add a directional vector, it is not sideways or lower, right? It is not stable and it is not lower. There we go. So with that being said, the tech sector continues to have a thorn jabbed in its side. That's what the TNX is doing ultimately. And if we take a quick peek at the countdown to FOMC, there's a couple of things I want to point out. First one is that we are starting to see the market firmly price in the 75 basis point rate hike, right? We're targeting 300 to 325 from 225 to 250. There's a slight possibility, 18% chance as of the close on Friday, right, that we're going to get the 100 basis point rate hike. I don't think that that's on the table. Usually the Fed does whatever the expectation is, and all they do is they come out and they talk. And when they talk, people's perception is, okay, maybe there's the possibility of the 100 basis point rate hike, and the market falls accordingly. It's almost like a self-fulfilling prophecy. So it's very likely that the Fed will give us what we expect, but they've done their job by talking and saying, hey, we're just going to continue to do whatever's necessary. That's the wording they use, right? To keep inflation under control, which might imply at some point in time we'll get the 100 basis point rate hike. But as of right now, not the case. The next thing I want to show you is if we go out to December and see what the target rate is for the end of the year, it's 400 to 425, and we're currently sitting at 225 to 250. We will be getting an updated SEP, Statement of Economic Projections, so we'll see if that changes there. We'll be getting some further on down the road projections, right? But what does this mean? If we get the 75 basis point rate hike on Wednesday, then that'll bump us up to 300 here, and now we've got 100 to go into the end of the year, and split between two meetings, that quite clearly is a 50 and a 50, or a 75 and a 25, right? So there's a number of ways we can look at this going forward, but if we get the 75 this upcoming week, we've got 100 basis points to go until we're at the target for the end of the year, which would of course mean lower rate hikes going forward. It would be very rare, I would say, that we would get 75, 75, and then a 25. They would probably taper it off sooner and go with something like a 50 and then down to a 25 or two 50s back to back. You get the gist, right? So can the market see some slowdown in the aggressiveness of the Fed here? It's possible, and that's kind of what this chart is explaining. Anyways, tying it back to the market overall, that would be a good thing for the tech sector, right? Because it would mean that rates are slowing down. They're not as aggressively going to be trending to the upside. So that was your in-depth look at the rates, a little bit more of a fundamental take, but it's fun to do, and I know you guys enjoy it. The VIX is up next. Here's our mispriced volatility. It's clear as day. Why is it that on an absolute horrible move to the downside here, the VIX is still contained within this little box here? It's not elevated, right? The market is getting used to the amount of volatility that's out there. If the Fed comes out and completely shocks us with the 100 basis point rate hike, you better believe that this thing is taken off to the upside over the 28 handle. And as we've been saying, just to give you a rough idea, right? If a capitulation bottom is around 38 and 40 in the VIX, let's even round it down a little bit. Let's get crazy here. Let's call it 35. If we get a 35 read in the VIX, what does that mean for your SPY? Well, if this is VIX 28, VIX 35 has got to be, 360 and possibly lower. So do be aware of that. The market is not really pricing in risk, in my estimation, in a reasonable fashion. The VVIX is up next. What's happening here? Even as we're seeing these high degrees of volatility in the market, still no one is buying SPY puts and no one is buying VIX calls. Why can we say that? Because this is still depressed underneath our 103 critical level. I can grab a lot of time here. Let me go ahead and grab a lot of time. Let's go with 5 years. Even data before the sickness and things got crazy, right? Look at where a normal spike was in the VVIX prior to the sickness. Up here, above the top of this gray bar, right? 103 at at minimum, right? Look at all these spikes. No one is hedged properly, and it just blows my mind that this flood effect is still on the table. Now, I might be, completely wrong here, but this is not adding up in my own head. I even went so far as to start looking into the volatility's futures, right? So if you look at the VIX or the VX futures, right, the volatility index futures, normally a market that's this volatile right now will be in some form of backwardation. And that just means that the front month volatility is more than the back month volatility. It is not the case. So they're still currently projecting that this volatility is nothing. Why is it that the market's still pricing in volatility will be higher in the future when we're in one of the most volatile times we've seen in the market in the last, I don't know, it feels like forever almost, right? So how can I prove this? Let's go down to the October and November. So we, of course, just want to focus where the volume is. Let's go ahead and drop that down. Oops, why is the volume not loading? So I apologize. This was available, obviously, as we closed out on Friday, but now we're not going to get our volume reads. Basically, you only want to pay attention to contracts that are trading some serious volume. So let's use the V contract in October, right? That was the one. Currently priced at 27.10, and we'll go out to the November contract. Here we go right here. The X22, currently priced at 27.46. There is more volatility in the future compared to in October. Again, that baffles me considering the exact circumstances of where the market is at currently. So that is kind of your VIX analysis, if you will. I know we don't typically go that deep into it, but we are in Contango, which is fine, not backwardation, which is what we would expect in a market that's this volatile. So not adding up from my perspectives. Here we go. Top right-hand corner is going to tell you what this is. This is the internal screen. It's going to show you how to set it up, what it all means, how it'll help you make better intraday trading decisions. In the volume, because that's really where we want to focus first, all of the selling has been confirmed by significant outflows underneath our negative 300 million, even scratching at negative 600 million. That does make sense. The selling here has been real. The outflows are not fake. It's not like these sell-offs are happening on light volume. Everything underneath the hood supports it from that perspective. On Tuesday, with the CPI disaster, we were way overcorrelated to the downside. Wednesday, we neutralized it. Thursday, we neutralized it. We're back to feeling okay. Friday, we're back down towards being overcorrelated. This is one of the reasons why I do expect that we could see an early week pop to the upside. If this comes into the zero line, starts fading off and doing something like what we saw here Wednesday, Thursday, that would neutralize us once again. And remember that a rotating market keeps a trend alive instead of an overcorrelated state. If we continue to get overcorrelation, I think it builds the case that the snapback will be stronger and more wicked than you might be prepared for. So that's what I would say about the advanced decline line, and obviously your ticks confirming, again, the selling activity across the entire marketplace, not just concentrated in individual sectors. So you can see, the sell-off, everything under the hood did support it. I don't have any qualms about this being a fake move to the downside. Everything adds up here. Again, I would say that the main takeaway for early on this upcoming week is the overcorrelated state for Monday. Can we get a little bit of a snapback? Here's the market profile. Last thing for us in the S&P 500. Here we go. Let's maximize this. You don't need to see the full dashboard. The TPO charts are what we care about. There we go. So poor high, poor low. And by the way, here's another video for you, top right-hand corner. I've got you covered. Every single time, I've got you covered, I promise. So this is the market profile. Watch that video if you don't know what I'm saying here. Poor high, poor low. Absolutely. Any opens inside of range, look for breaks of the low or of the high, just based on them being poor. What I would also point out, let me go ahead and auto-fit this here so it's a little bit better on the eyes, is that the point of control and the value area has been consistently moving lower with time. That, of course, is bearish. Here's your value area on Wednesday, Thursday, Friday. Point of control, point of control, point of control, all shifting lower, confirming the bearish nature. Here is the spike that I was referencing, right? The tone will not shift in your S&P 500 until we can get over this level right here, roughly 39.96 we've been calling it in the ES futures, okay? And in the S&P 500, it was the 397.75, right? So that is an explanation of where those levels are coming from. So far, all of the bearish price acceptance has taken place beneath the spike, which again confirms the bearish activity we've seen thus far. Let's get back on over to the platform and round out the broad market here with the QQQ and IWM up next after that. Let's go to, let's not look at so much time here. 5 years is a bit much, I would say. So let's go to a yearly time frame chart. There we go, zooming in. Thank you guys for bearing with me. If you've enjoyed the analysis so far, do me a favor and hit the thumbs up button. This, on a relative basis, has been weak, right? We've talked about a breach of the support trend line a long time ago. This gave up the 50 SMA on the gap down from CPI. the psychology and what we discussed on the S&P will be roughly the same. There's no overhead gap to be trading for here early on in the upcoming week, but you're looking for a rotation into 292 and any rejections there or slightly higher at 296 because that was the breakout level here. There's your 296. Obviously, the breakdown came a little bit after that, but 296, both of those areas are short points. Notice also that the dashed line, the single prints in the QQQ are aligning with that 296. So anything that really comes to here is a pretty ideal short opportunity in my estimation. If we get the bounce, look for lower highs to be produced around 296, and then your rollover is back down towards our 288. If we don't get any upside, again, I would not chase this short in the hole. You're basically the last one in the door, right? I would watch for sideways, build this out as a bear flag, and then after multiple days, it might actually be too late. We might have to reassess after FOMC. I don't think that one day on Monday and then breaking down on Tuesday is enough, but ultimately if this does build out as a bear flag and go, your next target underneath is 280.75 coming from this set of lows right here. Okay, so those are my numbers. Those are my expectations for the Qs. Psychology is the same as the SPY. What do we have going on in the IWM? This is above its support trend line. It is hanging on by a thread. It's gap down, went right to it, a little bit of a poke through and closed pretty strong back up towards the highs of the Friday range. So oversold bounce, yes, absolutely looking for an exhaustion move to the upside over 179.76. Fills the gap towards 180.70 and then possibly higher. This is going to be the equivalent of the spike level. It's not technically a spike, which is why it is not a dashed line, but 183.50 is where you would look for the lower high here in IWM if it is going to play along nicely with the broad market. And then, of course, this one still has a breakdown point. 178 is the number. If that breaks, if this super support gives, look out below. Bottom end of the weekly expected move is probably on the table at 173. Remembering that this is a risk on, risk off indication. Right now, surprisingly, it's showing us risk on because there's relative strength here, which aligns with what we saw on the ratio grid just a moment ago. But if this breaks, right, that is where it opens the door for more of that nasty downdraft in the S&P 500. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that being said, we'll hop directly into Apple. We'll keep it brief here. I know the videos have been getting lengthy recently. Let me know if you like or dislike that. But regardless, Apple looking for the back test of 154 for better shorts. There you can position for the rotation into 147 coming from here and possibly lower into 142.85. If we are going to see upside in Apple, it's got to be the full dead cat bounce and higher low produced above 156.50, and only if that happens, you can start to look for your 162.25 target on the upside. Next up is Netflix. What's going on in Netflix? Great relative strength here ever since they announced the free version of the platform. You can see we've got 2 daily closes outside of the range here. A little bit more firm on the Friday session. If we can breach the 2-day highs, it is targeting the bottom of the overhead gap. 250, it's coming back into play. Can you believe it? I would make sure that you're only looking for these types of bullish trades before the FOMC and, hold your breath and be very aware of your risk as we come into that Wednesday at 2 o'clock announcement. Anything can kind of happen, especially with all of the volatility we've been seeing and expressing, especially in today's video. If we rotate back underneath 234, that is a look above and fail. Our target will be 215 over the course of time. Next up is Tesla. Really ugly chart just going sideways here. Looking for the possible breakout over 305.13. Again, pre-FOMC for the quick scalp into 311.70. From there, again, because the flag is just underneath, I'm not sure if we're going to run into massive sellers. We already had a fake out on Thursday. I would be very skeptical in here. The better long, if you just want to be purely patient, I would commend you for that. And the better long is over 311.70, clearing all of that, these prior rejection points, your target overhead 325. Anything that just remains in this kind of box right around in here, neutral, choppy, scalps, back and forth only. Short trades, only if we can breach and get a firm close under 287.50. Next up is Google. Google. What's going on in Google? Clearly a hammer candle on Friday. I would say this looked more like an exhaustion setup where we can see a little bit of a rally, but I wouldn't look for very much, and I'm not even sure I would look to participate in it on the long side. I think a lot of charts are in really, really tough positions here, honestly. They do feel overextended, so I wouldn't recommend going short here, but we're also underneath a massive monthly range. So think of all of this as overhead supply, just waiting to sell for break even. Very, very difficult to look for a long into that area, but it's also not a short, right? So I think patience might be the better play here in Google. Waiting for either consolidation that remains underneath 104, then breakdowns can start to target this ancient gap. We've got a gap from 99.60 down to 97.44. Let me show you that on a extended time frame here, and then we'll move our our tails along. There you go. There's the gap. Okay, so that's where it's coming from, but Google might require some patience just based on its tricky positioning here. Meta is up next. Again, leaving it zoomed out, I suppose, so you can see where that downside level is coming from. There it is, prior lows. And if we zoom in, obviously big relative weakness should not come as a surprise because this is in the communications sector. I would say looking for any, these two levels, hourly chart's going to be our friend here. Let me be abundantly clear on the hourly. Here we go. Any rejections off of 149.13 are viable. Any rejections off of 151.65 are also viable. I would not really be trading for these as longs unless the setup is too good to be true and you've got to take it. But instead, I would look for rejections either at 149, 151, or 155.65, just because there's so much relative weakness out here in the communications sector. So those are the numbers. Those are where that is where they're coming from. And again, the chart here, it's tough to short this on the lows without a little bit of a rally first. So patience is the play if you're looking for downside. If you want to play it long, fine. Long over Friday's high and hold on for dear life. Be ready to bail at any given time if we reverse off of those points that I was just telling you about. Here we go. NVIDIA also in a very tricky spot. We've got a daily range here. We're right up against it. So early on, failures of 132.75. Maybe it's bearish back down to the lows and a break of 127.82. I would just trail a stop lower. The reason for that is because we've been expressing here that we've got our high volume node, the highest volume node I have seen in a very, 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 very long time. I would not want to be shorting aggressively against that, noting all the volume support here. So tricky spot in NVIDIA, not really that attractive early on in the upcoming week. Just trying to set this back to normal. There we go. Moving along. Next up is Microsoft. What's going on in Softy? Zooming in a little bit here. Again, these charts are in very, very tricky places. I do think that this is a better long than what we just described in Google, just based on the green hammer. Your upside's a little bit better, right? And obviously, if we're going to come in for a back test of the breakdown point, getting my words mixed up, we're looking for 250, 350. So there's better upside range here. So Microsoft, that might be on the table as a viable trade, bouncing off of this, producing like a monthly double bottom, maybe. But we're not counting on that to hold. That's for sure. I'm just saying we could bounce off of this area of support if we take out the hammer high. Again, you're probably not pushing your luck much further than 253.50 on the upside, okay? That's Microsoft bearish overall, but a rally can be produced over the Friday high. Last but not least, Amazon, the mini beast. What's going on over here? Really, really tough chart as well, just because you've got this overhead supply, so selling pressure is there, but we've got the hammer from Friday. So possibility to close the gap and then reverse off of it. The gap is from 123.80 up to 125.25. That would be the ideal situation for a short, and ultimately you want to see it come back into the breakout level from here, 117 on the downside. If we do get acceptance back in this range, then my goodness, choppy, intraday trades, scalps only, nothing really from a day time frame perspective or daily chart perspective, I could tell you if we just come up in there. So overall, pretty tough out there from an individual company's perspective. I would really be focusing on reducing exposure, making sure you're focusing on the best trades, especially ahead of the FOMC volatility Wednesday at 2 o'clock. Another quick reminder to hit all those buttons YouTube tells us to tell you about, and let's get right into these ideas here. ROKU is up first on the chopping block. You can clearly see the beginnings of a 1, 2, 3 bar play. There's your 2. All we need is a 3 to take out these highs from right around in here, 73.64, and we're off to the races to the breakdown point. Scene of the crime, 80.46, 80.50. Do bear in mind we have a 50 SMA, which could offer some resistance early. That is a bullish trade if the market's moving higher early this week. Do not want to be interested if we take out the low of the inside bar at 70.84. Next up is First Solar. FSLR is the ticker here. Bull flag. Solar had a massive rally, or just great relative strength, I should say, over the past month or so. You could look at this as a flag with a trend line, or just wait for the breach of the highs here, 140.14, and we're basically trading into blue sky territories. I do believe, I don't want to bite my tongue here, so let's grab some more time just to make sure. And there we go. There's a 4-year chart. Yeah, for all intents and purposes, relatively uncharted territory. So very bullish here as we move towards uncharted territories on the upside. Blue sky breakout of this flag. Not interested if we crack underneath 131. Next up is NFASE. It's also in the solar space, obviously. There's no flag. It's just an equal high set here at 320.43. A little bit of a different price point, obviously. So depending on what's right for your account size, you can look at either setup as a bullish trade here over the break of those highs. You've also got this sort of trend line going on here. You probably want to see it stay above if you're looking to be bullish in solar. Next up is eLilly. LLY is the ticker on this one. A very, very simple setup. We've got 4 days of balance after the CPI. We know that healthcare has been holding up okay. So if this wants to break out of the top, we're probably looking to fill the gap and come into here. That's a move over 312.30 to close the gap 315. 315 is the number, and then the highs are 320. So that's your upside trade, and that would also be a doubling of the range, right? So very simple, over and under here in LLY. Last but not least is KMB on a nasty bear flag, inside bar, double inside bar setup here. There's your bear flag, double inside bar setup. If we breach 121 on the downside, kiss it goodbye. You're at least, like on a day trade, this would be it should be a very easy move. If we break this little flag here, you're looking at 120. So about $1 move to the downside, 1 delta on your options, and if not further than that, you're probably looking at the lows here around 117.50, and that's also roughly aligned with the expected move of that particular pattern. So those are the trade ideas, long and short. Hopefully you enjoyed today's video. If you did, feel free to give it a thumbs up or drop a comment down below. I wish you all a great trading weekend if you're trading crypto, and a green trading week upcoming. Be mindful, FOMC, Fed, 2 o'clock on Wednesday.